Welcome back. It's time for the Word on Wall Street. Top investors watching your money. Joining me right now is a watchdog on Wall Street, radio show host and Markowski Investments president, Chris Markowski, back with us. Also with us this morning, Rebecca Walser. And Rebecca, I want to kick things off with you here. As we look at a market that is trading down this morning, down across the board since July, actually, on the final trading week of September and the end of the third quarter. Moody's is now warning that the U.S. is risking losing its top credit rating if the government shuts down next week. Rebecca, what are your thoughts on the backstory here as we approach the fourth quarter next week? We're going to be getting earnings coming out. What are you focused on with regard to the impact on money?
Well, Maria, I always thought that the second half of the year would be the true test of this market this year because of so much stimulus money and obviously the Federal Reserve giving us the BTFP program in March. This was going to be the time, the second half of the year, and we're seeing it now. We're seeing that we're just running out of money. Our money supply is retracting. It's recessionary level retraction on M2, and we are just getting out of the stimulus. With student loan debt kicking back in next month, we're going to see $5 billion less of discretionary spending that we've been used to for the last 3 years. And so obviously all of that with the headwinds of Germany and really just depression level manufacturing status and China's Wuhan having major problems right now. I expect we're going to have a lot of problems ahead. And 750 stocks yesterday hit their lows, 12-month lows. And that includes UPS, Pfizer, Target, General Mills. So this is across the board. The breath has been very shallow on this run up for this first half of the year. And I think we need to be prepared for bad news ahead.
Yeah, I mean, I'm just wondering if the fourth quarter will mean a sell-off versus what we've been seeing year to date, Rebecca, because, look, we're finally seeing the impact of those 11 rate hikes. As you said, it was really the second half that we were focused on. And, there's a story in the Journal this morning. Americans finally starting to feel the sting from the Fed's rate hikes. You've got rates going higher across the board. And Stephanie Pomboy has mentioned in the past bankruptcies and companies seeing a very different scenario in terms of their own costs. Is that going to play out in the fourth quarter?
Well, we've seen so many Chapter 11s move to Chapter 7s, where you actually can't even get a restructuring because there's no financing, Maria. The liquidity, this system is based on liquidity and money flowing and really easy money. Let's face it, since the dot-com crash of 2001 and 2002, we have had an easy monetary system. And this is the aging of that system and the coming home to roost of free money flowing for so long. We're not prepared, and with interest rates at this level now, people can't can't finance houses, and businesses can't get credit, and that's when you're going to look at a system lockup.
Yeah, in fact, J.P. Morgan CEO Jamie Dimon did an interview in India warning, Chris, that the world is not prepared for the Federal Reserve interest rate at 7%. In a time, this is in a Times of India interview, Dimon says this: "I am not sure if the world is prepared for 7%. I ask people in business, are you prepared for something like 7%? The worst case scenario is 7% with stagflation." Chris, Jamie Dimon has been warning about, worry under the surface for a long time now. And he said it again.
It was last year was the hurricane that got everybody all riled up last year. This is why I'm not buying the Federal Reserve. Everybody's talking about higher for longer. I'm sorry. I agree with Rebecca 110%. You've got all sorts of issues that are screaming recession coming down the road. And listen, I don't really care about the GDP numbers because anybody can be their own do-it-yourself economist right now. You speak to clients out there, they're like, what in God's creation is going on with the expenses that they pay, oil, food, you name it. That's what's most important. Yes, we're going to get juiced when it comes to the GDP because all of this government spending is coming down the pike starting next year and the year after. But the reality at home is what really matters right now. And again, we got a political season that's coming into next year, and I think the Fed's going to feel the pressure to lower rates next year.
Well, we'll see. I mean, the market rallied so much this year on this whole notion that the Fed is going to be forced to cut rates at some point next year. But look, Chris, look at the data that we're looking at already. We've got a big week of data. We're getting the July Case-Shiller home price index out this morning at 9 a.m. We'll get the August new home sales out at 10 a.m. So we'll get a window into housing. But then we're tomorrow looking at durable goods orders, the final read of the second quarter GDP on Thursday, and then the August PCE index on Friday. undermining all of these numbers, Chris, is the price of oil. Okay? If you've got oil prices at $90 a barrel, that's going to dictate where inflation is. Everything's got to be transported. So the price of oil and gasoline is embedded in those inflation numbers.
It's also farming season as well. So you've got all the farmers that are going to be paying a hell of a lot more for diesel based upon these prices. And obviously that's going to filter down into food. And this is where I'm telling everybody to be cautious. Yes, we've had a major run up in the market. But if you look at market breadth, what is it, year over year? What is it, the S&P 7%? If it's market weighted, that's not so great. 1% over the course of the year. This is where, again, investors have got to be smart. There's value that's still out there. You just got to look for it. You've got to understand, where's the government spending money? Because that's going to be the driver in 2024. I'd be looking at infrastructure stocks, very much so, and also defense stocks as well. You're going to have to replenish a lot of those supplies.
Yeah, it's a great point. I mean, Rebecca, at this point, it sounds like you both are basically wanting to sell into any rally. Do I have that right?
I mean, I am definitely not in a buyer and buying position right now. There might be, like Chris said, some wins out there, but you have to look for the value because it is overall, this market is in for some rude awakenings, I think.
Yeah, I mean, Nancy Lazar is one of our regulars, guests here, and she said that she pushed out her recession expectation into end of year next year. So, Chris, at some point, you've got to face the reality of what's going on. Maybe, the employment numbers held up this year. Maybe we don't get a recession till next year. And coming to your point, forcing the Fed to cut at some point.
But I mean, in reality, what's a recession? You got to get the high priests in Cambridge that automatically decide, oh, yes, we're in a recession. We had 2 quarters of economic growth. We've had that before. And again, I'm looking at it based upon my clients. I'm not looking at it based on what the government or the high priests are telling us. Am I selling everything? No. I'm taking a look right now to rotate assets. So you've had assets that have done very, very well over the past year. You want to rotate. Okay. You want to take some profits off the table and look for value.
That makes sense. Thank you so much, Chris Markowski, for joining the conversation. We so appreciate you. Rebecca, you're sticking with us all morning, and we are grateful. Thank you.